Hi, I'm glad you're with me today. Today we're going to start a new series. In light of the fact that we're in a pandemic, I thought it'd be a good idea to do a playlist series on my YouTube channel called Mortgage Solutions in a Pandemic. So what we're going to do is, this is the first, and we're going to look at a range of different potential solutions to help you in a time of crisis, but also what things not to do in this type of time frame in a pandemic oriented thing with the equity in your home. What not to do, what to do, what you could do, solutions to get you out of a bit of a pickle. And so the first one we're going to do is on reverse mortgages. So should you not do a reverse mortgage? Is it even a good solution in good times, never mind in the midst of a pandemic? So I'm going to address that. And then just know that there are two banks in Canada that do offer this reverse mortgage, and that I am contracted with both of those banks. So I can do those mortgages. So if you did want to talk through that solution and you wanted to have a private Zoom call with me or a conversation on the phone, go to my website, markalbertmortgages.ca, find my contact info, reach out to me, and we can set up a discussion, just a preliminary discussion to see what's best for you. So reverse mortgage, why do they call it a reverse mortgage anyway? All right. The term reverse mortgage has actually had a bit of a negative connotation in the minds of people. In the US, there's been some not so good products with that label. In Canada, we're pretty tightly regulated, and the products are pretty good. And so, so a traditional mortgage, a typical mortgage, pretty much all mortgage products, you make payments to the lender, right? So you make payments to the lender. So the payment is directed towards the lender. Whereas in a reverse mortgage, it's really the payment that is reversed. So instead of you paying the lender pays you tax-free money, which comes out of the equity in your home. So that's why they call it a reverse mortgage, is because instead of you paying the lender pays you. Everything that gets to you is actually your money anyways, because it's coming out of the equity in your home. And government rules allow us to receive that money tax-free. So because it's tax-free, it will not, if you're receiving CPP or old age security, or if you're in a certain tax bracket, you don't want to get bumped up to another tax bracket, it won't hurt you at all. So it's a tax-free in terms of income. All right. So that's a little bit about that. So generally speaking, you don't have to make payments on this product. Okay. And you have to be 55 years old. Okay. So if you're 55 and you own a home, or if you and your wife are 55, or one of you is 55 or older, you can qualify for this product. A traditional mortgage, you got to go through the stress test pretty much on all mortgage products. This product, the stress test doesn't apply to you. It's based on other variables. So the stress test won't apply. So if your income is really low, or you got laid off from work and you have no real income, you can still qualify for this mortgage because it's based off the estimated or appraised value of your home. And you could potentially receive up to 55% of that tax-free. Now, just because you could receive 55%, I would not necessarily say that you should. So just keep that in mind. So there's no regular payments. So you could choose to make payments if you want. If not, what happens is what should be payments, they actually come out of your equity. So the interest on the loan comes out of your equity, so that you don't see payments. You don't actually physically have to make them. All right. So you can receive a lump sum, or you can receive monthly. So look at the person who they're 55, 60, 54, 56, 57, whatever, and they're working, and they just got laid off, potentially temporarily, or for a period of time from their work, they pretty much, they're debt free, they're mortgaged, there's no mortgage on the house, right? So this product may be available to, instead of them saying, what are we going to do, is you can get this product on a mortgage and potentially, you know, maybe a $25,000 loan, right? And then you just pay a little bit of interest on that small amount. If you say, well, we need $2,000 a month in addition to our other income, you can actually set it so that you're receiving $2,000 a month. And let's say we go back to work, you can stop that $2,000 a month, okay? Now I will say this, now there's two banks, right? Both banks have slightly different interest rates. Both banks have good products. They're pretty much the exact same product in both cases. And one of the banks advertises on TV. They spend a lot of money on marketing, so that is reflected, I think, in part in their rate. Their interest rate is a little higher than the other one. No one knows about the other one. Most people don't. So I'm not going to talk about them specifically, but I'm just going to give you the understanding on this product. So let's say you get this reverse mortgage. You don't want to just get in it for like a year and then transition out, because in the first 3 years that you're in it, to cancel the mortgage, the penalty is a little higher, right? So what happens is after 3 years, your penalty is just 3 months interest, which is very traditional on particularly the variable rate mortgages. So it's not a big hit. After being in this mortgage for 5 years, there's no penalty at all. You can get out, no problem. So if you're in a bit of a pickle right now and your income is down, therefore you wouldn't be able to qualify for a refinance, this might be a product that might meet your need if you're in that age category. Okay? So if you have questions, add those, please. And I will say this, a lot of times, because I've been a financial advisor for many years now, for about 10 years, and I've been doing mortgages for about 5 years now. Licensed mortgage, I'm doing mortgage before that, but now as a licensed agent through a broker. So what I find is over the years, people work, they save a lot, maybe they build a lot of RSPs, and then when they get later in life and a crisis comes, they start pulling money out of their RSPs, okay? So if you're in a bit of a pickle, instead of pulling $50,000 out of your RSPs this year, what'll happen if you do that is you're going to be charged withholding tax. So you're going to get hit on taxes, a double tax, two taxes, withholding tax. So you have a withholding tax, then you're taxed as if it's income because it is considered income through the CRA. So when you file your income tax, whatever you made plus all of your RSP redemptions, so it may throw you into a higher tax bracket. So then you may have to have a big tax liability in the following year when you file for your 2020 taxes. So instead of pulling out of your retirement for the future, you could move into this reverse mortgage, receive the money tax-free, be in it for at least 3 years, and then after that, you know, you probably be working again, things will be settled, and then you can transition out of that mortgage if you want, or you can stay in it, whatever you want. But those are some thoughts. Sometimes people save their investments for decades, and then all of a sudden, later in life, they get in a difficult situation and they start pulling them prematurely. So the reverse mortgage may potentially help you from having to draw on your retirements in advance. So let's say you have a couple rental properties. You have one rental property and you have the house you live in. So this mortgage, the reverse mortgage, is for the house you live in. But if you have a rental property, you may be able to get a reverse mortgage for your home that you live in and have a blanket mortgage over up to 2 other retail properties. So, and again, that means that you wouldn't have to make payments on this product, and then you would be able to maybe extend grace to the renters for a time. So this product, you can receive tax-free money. There's no monthly payment obligations. your flexibility on the advance of a lump sum or of receiving monthly or both. And you own the house. So in the U.S., there used to be some bad products. I'm not sure what the status is anymore in the U.S., but in Canada, you still have title on house. You still own the house. And then whatever amount gets eaten up of the equity of your home, because what happens is, in this particular recession time, the value is going to go down, right? But then traditionally in the Greater Toronto area, in many parts of the country, value just keeps going up. And then there's a correction in the market, and then it keeps going up. So if you look at it over the decades, the value of homes just keep going up. So if you keep eating up a little bit of the equity in your home, the value of your home keeps going up. So at the end of the day, you still can retain a lot of equity even with this product. So let's say if you pass away, the home becomes part of your estate because you were owner, the bank is not owning this, and then at death or when you sell, basically from the proceeds of the sale, it pays off the remaining of the debt, and the rest goes to you if you're alive, but then if you're not, it would go to whoever, to the estate. Okay? So if you have any questions on this product, reach out to me, markalbertmortgages.ca. If you're in the Greater Toronto area and you want to talk through your mortgage situation and see what's the best solution for you, because this product may not be, please reach out to me. Happy to help you for a free consultation on a Zoom call or even over the phone in these days. Listen, be safe, have a great day, and much success to you.